All right. So a lot of these things we talked about in payroll accounting, these non-taxable employee fringe benefits. So these are items that would not be then included on an employee's W-2. We're talking in this section just about items that are through your employer. So no additional cost services that are provided to an employee, spouse, or dependent children. So this is when they give something, but it doesn't cost the business anything. I think they use the example here of like airline tickets. So if you're an airline employee and the airline has open seats, it doesn't cost them any more to give an employee that extra seat. I mean, I suppose there might be some negligible extra fuel cost, but it doesn't cost them anything. And so, or unsold hotel rooms, it's not costing them any more to give that. So that's not taxable to the employee in that case. Discounts that are provided to employees, provided to employees for products or services that are normally sold by the business. So if it's something that's out of the ordinary, it's not normally sold by the business, that's a separate story. So reduced price meals, discounts on clothing, reduced interest rate loans, that from a financial institution. So the discount cannot exceed the gross profit percentage, and the maximum discount is 20% of the normal selling price. So I can give to you a discount, non-taxable, but only up to a 20% discount is non-taxable. Working condition fringe benefits. So these are things like professional organization dues. So for example, a CPA might belong to the Iowa Society CPAs or the AICPA, and the business pays for that membership for them. That's not taxable to the employee. Also, use of an employer-provided vehicle for business purposes. This gets a little complicated, and we talk more about this in Chapter 6, these business autos, because oftentimes employees that have company cars, they also use them for personal purposes. And in that case, for the personal purposes, it is taxable to the employee. And so there's some intricacies in keeping track of that. Qualified transportation fringe benefits, so up to $315 a month in like mass transit passes or parking fees can be provided to the employee at no cost. It's not taxable to the employee. Different from if they provide you with, like they have a parking lot and you can park there. That's not really, that's a little bit different, but this is where like, you know, you have to park in downtown Des Moines and you've got to pay for the parking spot in the parking ramp, that sort of thing. They can pay up to $315 a month for you, for employees, and have it not be taxable. Other de minimis benefits, things that are just really small, and the record keeping would just be too overwhelming to actually keep track of it. So they use some examples of like holiday turkeys, company picnics, coffee, that sort of thing. Let's see. So insurance, reduced cost or fully paid accident and health insurance. So the amount that the employer pays toward that is not taxable to the employee. Also, which is a really great benefit because most of us know health insurance is super expensive. So the amount that the employer pays is not taxable to the employee. What else do we want to say? $5,250 a year for educational assistance. So if your employer helps to pay for your college tuition, up to $5,250 is not taxable. The same applies to student loans. They could instead help to pay off your student loan. That would be awesome. But up to that amount per year can be excluded under, of the student loans can be excluded. So these are the amounts that the employer pays on your behalf toward paying off your student loan. And it was extended, I don't know if it was extended in the new Tax Act or not. I'd have to look that up because it looks like it had expired. It was originally going to expire the end of this year, but it may have been extended. I don't know. I'd have to look that one up. Employer paid premiums on group term life insurance, up to $50,000 of benefit. So if you were to die, your life insurance proceeds up to $50,000 of that benefit. So that would not be taxable. The premiums toward that benefit would not be taxable to the employee, but any amount of the benefit that would be paid that's over $50,000, the part of the premium that applies to that would be taxable to the employee. So we're talking about the premium being the taxable portion, not the benefit. But whether or not it's taxable depends on the amount of that benefit. And $50,000 is the cutoff there. Employer provided meals and lodging if they're furnished for the convenience of the employer. If it's for the convenience of the employee, it would be taxable. Dependent care assistance plans, so these are specific plans, flex spending account plans, and employees voluntarily participate in these, and it's actually the employee's money. It's amounts that are deducted from their paycheck, put aside for specific purposes, either for medical expenses or for dependent care assistance. When the employee draws on that, that makes the income is not taxable to them. I guess that's more the flex benefit plans. So just some of those fringe benefits and you'll recall that in payroll, we talked about a lot of those too, if you took the payroll class. Other types of non-taxable income. Scholarships and fellowships are not taxable as long as the proceeds are used for education and you're not required to provide any services in exchange for them. If you have to provide services in exchange for them, essentially it's earned income. Also, if the scholarship or fellowship payment exceeds the expenses, then the amount that it exceeds would consider to be taxable to the recipient. So we got Hilda, graduate student. She received a scholarship of $7,000, $4,000 toward tuition and fees, $3,000 to pay for campus housing. And she has a graduate assistantship that paid $5,000. Tuition fees and books cost $6,000 during the year. She can exclude $4,000 from her income. So she's going to be required to report wage income of $5,000 because that's the amount of the graduate assistantship she had to provide some services in exchange for that. $3,000 of the other income because it was for a housing benefit. So it's only the portion that's actually for the tuition and fees, not the housing. These qualified tuition program withdrawals, these are also known as 529 plans. Or actually, yeah, I guess they're, 529 plans, so where parents, grandparents, somebody puts money in them, and the funds grow. Interest, they grow over time. The interest accumulates, or the earnings accumulate. The earnings accumulate tax-free. And if you take them out and use the money for qualified tuition, then you don't pay any tax on any of those earnings. There's no federal deduction for the contributions to these plans, but there is a state deduction for contributions to these plans. So, life insurance proceeds. Life insurance proceeds are not taxable. So if you have, if you're the beneficiary of a life insurance plan, say your dad, mom, somebody passes away and they have life insurance and you are the beneficiary of that life insurance, it is not taxable. It doesn't matter how much it was for. It could be, $10,000, $100,000, $1 million. The proceeds are not taxable and they pass outside of probate as well. So that's one of those things. And oftentimes businesses will buy life insurance they will be the beneficiary if they have an executive that dies. So they'll buy a life insurance policy against one of their executives so that it pays them if that executive passes away. What's that?
Walmart got in a lot of trouble for that.
Oh, tell me more.
Walmart was, for some of their more healthy employees, they were buying life insurance on them, expecting them to die, and they referred to it in documents as get pest insurance.
Wow. That's pretty insulting.
Yeah.
Interesting. I'll have to research more on that. I hadn't heard that one. Let's see. So accelerated death benefits. So this is amounts on a life insurance policy. If the individual is terminally ill, they can get those benefits ahead of time. Those benefits would be excluded from gross income. They have to be terminally ill, not just chronically ill. So that means they're likely to die within 24 months. Gifts and inheritances. So this is a whole other area of the tax code. I don't know if you recall when we looked at the tax code in that first chapter, one of the areas was income, one of the areas was gifts. So it's a whole different area of taxation. If you have to pay gift tax, you file a whole different form on that. Now the recipient of gifts and inheritances never pays tax at the federal level. Iowa does have an inheritance tax, but if you're a direct descendant or a spouse, you don't have to pay that. But at the federal level, it's never the recipient of the gift or inheritance that pays the tax. It's always the person giving the gift or the estate of the decedent that pays the tax if it applies. So gifts, and it's only, I don't even know what the gift tax limit is. Last I knew it was like $17,000 per year that each individual could give another individual up to $17,000, and there was no gift tax that had to be, or no gift tax return that had to be filed. I don't know exactly what the limit is anymore. And the estate tax, my gosh, I don't even know what that's up to. I mean, that's not really something that we cover in this class, but gifts and inheritance are tax-free to the recipient. So if somebody gives you a gift, somebody hands you $25,000 and it's a gift, cool, take it. You don't have to do anything. Go, enjoy. But if you give $25,000 to somebody else, you may have to file a gift tax return. So usually what will happen is people will structure those so that they don't have to file the return. And just because they have to file a return doesn't mean they have to pay tax. Just means they have to file a return. So like if you were given $25,000 to your son or daughter and they're married, then what you might want to do is split that between the two of them so that you're under the threshold for having to file a tax return. But that's a different issue. So exempt from tax, payments received under workers' comp are tax-free. So this is where a worker is injured or made sick on the job, and they receive compensation in order to pay for their to pay for lost wages and, well, not necessarily lost wages, but to pay for the expenses that are associated with that. Different from unemployment. Okay, unemployment is when you're unemployed and you receive that. That is taxable. Workers' comp benefits are not taxable because it's seen as reimbursement for expenses. Damages, other than punitive damages, as a result of personal injuries or sickness. So if you get a personal injury judgment, then that is not taxable unless it's punitive. Punitive damages would be taxable. Again, pensions or annuities received for personal injuries or sickness from active service in the armed forces. And disability income, as I mentioned, Social Security disability income is not taxable. Veterans disability income is not taxable. Disability income by private individuals, if the premium was paid by the employer, then the disability income is taxable to the recipient. If it was paid by the recipient and it wasn't pre-tax, then it's not taxable. I know it's probably way more information than you need. But disability income resulting from a terrorist attack while in the employ of the U.S. engaged in official duties outside the United States. It's very specific. Other non-taxable, child support's non-taxable, public assistance payments, SNAP, housing assistance, all that stuff. Employer-provided adoption assistance. Remember with the Social Security benefits I talked about, employer-provided adoption assistance would be added back in to the AGI. The employer can provide up to $16,810 in 2024 to the employee for adoption assistance, and it's not taxable to the employee. It would be added back for purposes of calculating Social Security, taxability of Social Security benefits, but it's not part of the, it's not taxable to the individual. There are some income limits, and we're going to talk about that more when we get to the chapter on tax credits, because there's also a tax credit for adoption expenses that that kind of goes along with this as well. And that's what they're talking about with chapter 9. This is just the, is this all the, yep, shoebox to software. Okay.